everyone, welcome back to our channel. Today we are diving into a question many new investors ask. Can a SIP result in a loss? Let's break it down in simple terms. So first, what exactly is a SIP? Well, SIP stands for Systematic Investment Plan. It's a way to invest a fixed amount of money regularly, monthly, weekly, or whatever suits you into mutual funds. The idea behind it is simple. You don't have to worry about timing the market because you are investing consistently over time. Now, here is the big question. Can SIPs in equity mutual fund schemes lead to losses? The short answer is yes, they can. But before you hit that panic button, let's understand why. SIP is a method to invest in mutual funds, and equity mutual funds in turn invest in the stock market. As you know, markets go up and down. So, when the market falls, the value of your investment can drop too. But here is the thing, the real power of SIPs comes from riding out the volatility. Why do we say that? Well, over the long term, the market tends to recover from its lows. And with a SIP, you actually buy more units of the mutual fund when prices are low. This is called rupee cost averaging, and it can work in your favor when the market rebounds. But let's be real. If you stop your SIP during a market dip or withdraw too soon, you could lock in your losses. And that's where people often make mistakes. SIPs are designed for long-term goals, typically 7 years or more. So if you're investing with a short-term mindset, you might feel a pinch of market volatility. So can a SIP result in a loss? Yes, in the short term, especially if you sell during a downturn. But over the long term, SIPs have historically helped many investors grow their wealth even through the ups and downs of the market. If you're in it for the long haul, SIPs can be a smart strategy. Just remember, stay calm during those market dips and let your investment grow over time. Thanks for watching. If you find this information helpful, hit like and subscribe for more financial tips.